Hey everyone, welcome back. Today we're talking about efficient market hypothesis. So this was a hypothesis developed really to, at the crux of it, to say that price reflects all information that's out there. Actually, if you remember from Dow theory, this really is an extension of even what Charles Dow said, where prices completely discount all the information that's out there. And so this is really almost like an extension of that, but like a lot of things, when these things get created, it can be taken to extremes. And so we're going to look at it. We're going to look at what efficient market hypothesis is. There's a couple of different forms that it comes in, and how they try and attack technical analysis with that. And then we're going to look through a number of different outworkings of it, and getting basically to the conclusion that no, it doesn't properly consider technical analysis, and there is definitely still a lot of opportunity in the markets, whereas EMH would say that there isn't. So let's jump in and get through these slides. Stock prices, obviously this is now the basic tenets, if you like, of efficient market hypothesis, and that is that stock prices fully reflect all the information that's out there. Only when the information changes will there be a change in price. The current price is the best estimate of the value of the company based on all the information that's out there, expected dividends and all of those sorts of things. The returns, when risk adjusted, net back to zero. And so the point that they're trying to make is if the price goes up, that's because there's an expectation of more dividends or an increased dividend flow, or some sort of payoff because they're starting a new venture or something like that. Their point is that that gets immediately reflected in the price, and there's no way to beat that. You can't do better than what the price would have done. So it's not that you can't profit, it's just that you can't beat the market and get better returns than what the market would give you by itself. So there's a couple of different forms of that. One of the assumptions of EMH, which is really important to keep in mind, it assumes that all investors are rationally processing the information that comes. So it assumes that everybody's rational, is one of the interesting things. Now, obviously, I think you, like myself, would know lots of irrational traders. I know trades that I've made myself, which are definitely not rational. So yeah, but that's the core assumption there. Three forms of EMH. We have the strong form, in which both public and private information is completely encapsulated within the price. We have the semi-strong form, which talks about just public information. The price reflects all the public information that's out there. That's probably the most common of the three. And then the weak form of it, which even goes as far as to say that past prices have absolutely no bearing at all on where the market's going to go into the future. So let's quickly run through those. Start with the weak form. Knowledge of past prices is of no value in predicting future prices. It's the form that's often used to attack technical analysis. For those who adhere to EMH, they'll use that and say, well, according to EMH, there can be no way of predicting what's going to happen in the market. And so that's where they're coming from. Obviously easy to test. This type of form, and look at this to sort of say, hey, let's look at money managers that employ technical analysis. Are they performing better than a randomly selected monkey portfolio? Or are they performing better than the index funds? And that's, where a lot comes into. Now, unfortunately, there are a lot of advisors and analysts that partially use technical analysis, but still driven mainly by fundamentals, and they're not outperforming. And so it can be really difficult, and to group all technical analysts based on the research of a few is obviously very unfair to the discipline. But nevertheless, that's where they came from with that. This is a very hard topic to teach, as a technical analyst, having to teach all the arguments against technical analysis. Semi-strong form. All public information is reflected in the price. Basically, it's implying there's no such thing as a cheap stock or an expensive stock. because it can't be expensive because that must be the fair value of that stock. It implies that the current price is the best estimate of value of the company. It's difficult to test. You know, the semi-strong form, it's not so easy, but it is the most commonly held belief out there, as I said, and it's an extension of Dow theory to a certain extent as well, or one of the tenets of Dow, I should say. It's difficult to beat the market unless using high frequency trading. So, you know, when information comes out, the whole semi-strong form of the EMH will say that information comes out, immediately gets reflected in price. Announcement comes, bang, price changes, and that's now the new best estimate. The only real way of being able to benefit from that and see some sort of arbitrage is if you were front running the inevitable orders that would come out of the release of news. That's one, you know, way that you can get profit, and that's, you know, it's not necessarily illegal to front run, but obviously is definitely one way there. I think one of the other things which EMH doesn't talk about now, whenever, you know, my background was in signal processing and electronics and then computer systems engineering, but when we would have a signal like a switch being turned on and you would get an input into an electrical signal, often it would bounce up and then come down and then find a new level of equilibrium. The EMH doesn't talk about that. We see that same pattern in markets where news event comes out, bang, market reacts, then reacts strongly the other way, and then we start to get this balancing out going on. So again, you know, EMH is not talking about that and doesn't describe the overreactions to news and then the reaction to the reaction and those sorts of things. So lines of attacking for critics. Stock prices seem too volatile to be consistent with EMH, kind of what I was just talking about. You know, there's the way prices move, the volatility, you know, that really debunks one of the core parts of EMH there. Stock prices seem to have predictability. I mean, that's what technical analysis is all about. You know, and that's a big part of what we want to do at Optuma, is making sure that we help in the quantification of technical analysis and really building a library of statistical valid results that can really basically defend a lot of the technical analysis techniques that we're using. There are unexplained and perhaps unexplainable behavioural data items that have come to known as anomalies. And so these anomalies really again, undermine the whole EMH principles. All right, the third one is the strong form, and this is saying again, all public and all private information is reflected in the security's price. It includes private information which may be illegal to obtain or act on, so insider trading. General consensus is that this form is not necessarily true, because if it's not public information and there's only a handful of people that have it, how can it be reflected in the price? So even within the EMH world, most people would not really pay a lot of attention to the strong form of EMH. All right, continuing on, EMH beliefs. It is commonly believed that the strong form is not likely to be true, exactly as I said. Weak form is likely to be true, that past prices have no bearing going forward, but it's the semi-strong form that commands the most attention and interest. And that's information determines price, and no one can exploit publicly known information. All right, so then going on with that from a martingale perspective. Now, martingale, of course, was a system used in betting where, you know, it's basically based on the theory of runs, where if you were flipping a coin, you know, your probability of getting a heads is going to be 0.5, you know, 50% chance of getting heads. If I flip it twice, my chance of getting two heads drops to 0.25. We're multiplying the 0.5s. We do that again, we're down to 0.125. Do it again, we're down to 6.25% chance for 4 heads in a row, and it just keeps going. So, you know, once you get to 4 heads in a row, the chance that you're going to get a fifth based on the theory of runs is, very, very low. So all of that then went into martingale as well, and it becomes a characteristic of EMH because this whole thing of the weak form where we're saying, well, they're saying, I should say, that past prices have no ability to predict future. It's really saying that every single day, the price action is completely random and it pays no attention to what happened in the past. And we'll explain why that's actually can't be true. But nevertheless, that is what the martingale principle in consideration of EMH. So that's the mathematical view of the stock market. Random walk is a process where the next coin flip has a fixed probability that is completely independent of all previous coin flips, made up of a consistent growth factor and randomness around that growth. Now, this was interesting actually in the text. It goes on to explain that one way of actually bringing the martingale concept into the price of securities. We all know that over time, securities go up in value, whether that's that they're truly going up in value or whether it's a devaluation of currency, doesn't really matter so much. But when you've got that slope of what is the consistent growth factor, if you take that out, then you almost do get to this randomness about, and it can be considered like noise around the predominant slope of growth that we're talking about there. Past information gives no real clue to predicting future prices. There's a complete absence of predictability once you take out that growth factor. With the growth factor in, we can predict, okay, we're going to grow by 1-2% per year. But take that factor out and then we just don't know where it's going to go. So behaviouralists versus EMH. Behavioural finance argues that EMH is false and that the foundations need to be re-examined. So it's coming along, behaviourists are really looking at behavioural finance, saying people don't act rationally. They don't digest and consume the information in the same way. There are periods where there is crazy optimism and the market just goes into prices which don't make sense. And then there are periods of crazy pessimism, which again don't make sense. And so this is where behavioural finance just says, no, EMH is not right. We need to have a better model than this. One of the issues with EMH, and I think why it's become such a stronghold, and Andrew Lowe talks about this in chapter 29 of the text, is that it really was one of the first formalised theories on market psychology, if you like. And so it really captured mainstream academia and really got a foothold there, and obviously was taught to a whole generation of analysts and financial professionals. So that's that's part of why I got such a foothold. Doesn't necessarily mean it's right, and so that's what we've got to look at and do more testing about that. There are three different ways that are being attacked, and that's one is the logical argument. Purely from an economic theory point of view, like we've already talked about. Psychological argument, experiments on human psychology, throwing doubts on the realism of the financial theory. And empirical arguments, exhibits patterns of predictability, there's a bit of a tongue twister, in financial data that belie the assumed non-predictability of future asset prices. And that's really coming down to technical analysis. The models that we use where we have higher than random ability that a signal will lead to a increased return in the short term, or long term, however the signal's working. So, that really is an empirical argument, and that's what technical analysis has done over the last 15, 20 years, is to really start to quantify itself and become better at arguing these type of concepts. All right, so what we're going to do is continue with the next chapter, Forerunners to Behavioural Finance. So looking here again, so obviously EMH coming unstuck. Academics were obviously very happy with EMH up until 1987. In 1987, for those of you who remember, we had a really significant crash, 25% values gone, I think, in just a couple of days. It was probably one of the biggest, even bigger than 1929, the single day events that were going on at that point. So that year, if you'd looked at that year in isolation, it started around 2,000 points in the Dow, it finished around 2,000 points in the Dow, and you'd be saying, not really much of a year there. But what happened in between that year is that prices just went up. It was a massive run, 600-700 points going up into October of 87, and then bang, the market fell in October 1987. Now, what was really interesting is that there was no news, there was nothing out there that explained why the big rally, and then why the sharp drops and the crash of 87. And if you go and talk to a lot of different professionals and people who were working around that time, they all have different opinions on why and what was going on. But nothing from an EMH point of view made sense. Remember, EMH is saying that the price is reflected of the information. There were no fundamental changes to the fortunes of companies. And I think what's even more telling is that within 6 months of 1987, the pre-October high was taken out again. So, it really, in 88, most of the markets there, I think some of the other markets around the world took a lot longer to come back, but definitely the Dow Jones was back very quickly there. So nothing really made sense what's going on. And there's been other cases where, things just don't quite make sense. The flash crash, we still don't really know exactly what happened with that and how prices could drop and come back so quickly in a day. Who knows? So for these events to happen in the absence of information, again, debunks EMH, because otherwise there should be something that explains that rise up. Flash crash, okay, there may have been a computer glitch, but this rise up in 1987 and then the rollover and the crash, none of that made any sense. And so obviously I guess the EMH supporters would say that it was more speculation. Speculators don't form that bigger segment of the market to be able to drive it so long and so far. So the behaviour was bizarre, no information. So prior to EMH in the early 1900s, what's actually very interesting is that most of the academic papers written around the 1910s, the 1920s and 30s were all pointing to behavioural type influences and inputs into markets and market price. Now, there was no field of study like behavioural analysis like we have now. It was more just economists, speculating on what was driving prices, and often they were talking to behaviour, over optimism and over pessimism and things like that. So again, very interesting. Now, where this all comes back to then is looking at this and saying, well, what's going on? How does this happen? And that's really momentum versus mean reversion strategies. Now, this is one of the learning objectives, so you've got to have a clear understanding of this. The momentum side of the argument is in the short term, stocks going up will continue to go up, or stocks going down will continue to go down in the short term. That's what the momentum strategy would tell you. The mean reverting strategy would tell you that in the long run, stocks that have done well for a long time are likely to do poorly in the future. And obviously stocks that have done poorly for a long time are likely to do very well in the future. So the bottom line is don't do what everyone else is doing. And it's very interesting, if you're interested in the topic, we've got optuma.com/research, where we've got some research papers. In there, I did a research paper on why buying outperformers, I forget the exact title, but buying outperformers is too late, is the crux of the research paper that I wrote. Using relative rotation graphs and saying that once something outperforms, the gain that it has, the returns that it has going forward is actually a lot lower than if I would wait for something to be underperforming and showing the first buds of new growth and new relative performance. And that's, you know, the mean reversion type strategy. But anyway, you can read that once you've done the exam, and you can have a look at how all of that plays out. Obviously here this quote, you know, when you see a stock going up dramatically, jump on board because it will likely to continue to go up. If everyone hops on board and you perceive that everyone is on board, then you should hop off. So value investing, one of the other learning objectives was talking about value investing. Graham and Dodd in 1933-34 after the Great Depression, you know, we're talking about this and involved in a lot of value-based investing at that time. The value of a stock can be inferred through studying the financial statements, and thus in turn they could beat the market. What they were looking at was stocks that the price was just beaten down. But when they looked at the balance sheet and the P&L and what the company was doing, they're sitting there saying, hang on, there's a lot of information here that makes us believe that this stock's actually going to go up. And so they will then buy those stocks. And obviously with the expectation that they would go up. Now, value investing has become a huge part of our financial analysis. So many fundamental analysts will work along the lines of value investing, looking at the fundamental reasons why this is actually a good company, and not really paying attention to price. Price is merely the way of determining, hey, when I look at what the yields can be, am I getting a good, when I look at what the returns will be, am I getting a good yield by paying that price? And if it's not, then they wait for the price to come down and they jump on board. We've talked about that many times already. So focusing on stocks that have not done well but had value because investors are emotional and have ignored the fundamentals. And so they were capitalizing on that, are likely to be the best ones to own. Inversely, stocks which have been doing well for a long time, which everyone loves, and perhaps have deteriorating fundamentals, are not likely to be good buys. And I think we've seen that in the last few years with Apple. Apple's still a great company, very strong, but the euphoria over the smartphones and things seems to have waned, and you know, phones are now a staple. And so you expect them to be selling a few 100 million of them every year, and that doesn't necessarily drive the price up. And that's why we've seen Apple's price fluctuate over the last couple of years. There are ways to beat the market, and stock market prices are predictable, is really where they come back to with all of that. So why is value investing like mean reversion? Remember, mean reversion, even if we take the very simple RSI type concept, 14-period RSI, it's right down low in what we call our oversold territory. The expectation is statistically it's not going to stay oversold. You can even think of a theory of runs and martingale with an RSI. The expectation is that it's going to come back. Well, that's what value investing is as well. The stock is beaten down so much, everybody's just doesn't like it, where the fundamentals are saying this is still a good stock. And the expectation is that it'll come back up from that. So value is tied to investor psychology. Timing of buying and selling coincides with the extreme opposites of the crowd. Buying extremes in irrational pessimism and selling extremes in irrational optimism. So doing the opposite. When everyone's pessimistic, you know, that's when we need to buy. You know, read a book a number of years ago about, you know, when there's blood in the streets, then is when you need to go and buy. And you look at any of the great successful traders, investors, the Warren Buffetts even of the world, and buying when everybody else is selling is one of the key things that they've all done. Prices eventually move back to reality, which is our reversion there. All right, so that's the Forerunners to behavioural finance with 3 sections down, 2 to go. So we're going to contrast momentum strategies, mean reversion strategies. So having that understand, follow momentum in the short term, but expect mean reversion in the long term. Just make sure you know that one. Define the general concept of value investing, you know, looking for stocks that are undervalued, and then how it relates to mean reversion. Simply that the expectation is that an undervalued stock if the fundamentals are good, will come back up again. All right, let's continue on with noise traders and the law of one price. Whole law of one price is saying if we've got two commodities, and the example in the book is of two baseballs, but one's called a hard ball and one's called a baseball, but other than that, they're exactly the same. And so they're saying, well, if these two are identical, then they should command the same price. There should be no discrepancy in price at all, unless there was some characteristic, even a label may be enough to create a discrepancy in price, and we see that in clothing and things all the time. If the prices ever do diverge and there is no change, then of course the buyers will be buying the cheap one and they'll be selling the expensive one until they come back to equilibrium again. But of course that is only true when fungibility exists. Now, fungibility is the ability to replace or interchange items within each other. So money obviously is completely fungible, because I can raise money for one project and then divert it to another project instead. You know, it doesn't mean that the money that I've created for a vacation can't be used to add another room to my house. You know, it's completely fungible. There's no loss in value in making that change of transactions. So again, fungibility, it's the costless conversion between two exact assets. In the purest sense, you know, you can even think of it as an arbitrage, where there is a discrepancy and taking advantage of that to a certain extent. You know, the example is if I have a futures contract on gold, I buy that futures contract, the price of gold has gone up, obviously I've got my futures. When that futures contract expires, then I'm going to get delivered to me hopefully a lot of gold bars. So that is, you know, the fungible conversion of a futures contract, which is a futures asset if you like, to the actual physical. So that again is another example of fungibility. In the absence of fungibility, nothing forces the prices of two equal things to equality. Now, the classic example that's often cited is Royal Dutch Shell. Now, Royal Dutch is listed on the Dutch Stock Exchange, and Shell is listed on the London Stock Exchange. Now, the company is one, but the shares are separate. And so you've got one trading in euros now and the other trading in pounds. Now, the ownership structure is that Royal Dutch owns 40% of the company and Shell owns 60%. So you would expect in this environment with this law of one that they should always trade at 1.5. You know, Shell should be 1.5 times the value of Royal Dutch, and there should be no discrepancy between those two. They should always stay together in lockstep, as the information that comes in about the Royal Dutch Shell company, that should then be completely applied to both share prices. But that's not the case. We have this discrepancy, and the reason for that is the lack of fungibility. If I buy shares in Shell, I can't just go and convert them into shares in Royal Dutch. I have to sell them to get my pounds, convert my pounds to euro, and then go and buy Royal Dutch in euro. And with all of that going on, we would say there's no fungibility. We can't do a costless transaction between the two. So again, that's a great example of this. If two items can be at different prices, that puts into question many theories of EMH. Again, this whole thing of information. Well, if information truly did set the price, then you wouldn't have this issue show up between Royal Dutch and Shell. All right, noise traders, that's where we come in. The term originates from Milton Friedman's works and his view, somewhat derogatory view of speculators. Basically, he would say that the uninformed are moving prices away from efficiency and creating distortions in the market. Obviously, losing money over time is what he would say, because the smart traders would come back in and push the price back to the efficiency. They trade on noise. Now, basically what he's talking about there is that it's almost like a feedback loop where something happens in the market and then people are reacting to it and reacting and getting bigger and bigger reactions as things go on, but it's not necessarily based on the information. So, you know, he would talk about uninformed, speculative trading and what it's doing there. And that cartoon is quite an interesting one, you know, where they talk about Excel and then someone hears sell and it just gets bigger and bigger and crazier as it goes on. Noise traders are not rational or knowledgeable, is again what he was saying. They are not assumed, and so they're not assumed in financial theory. And this is a big part of the problem. And we'll talk again more about this as we get through the next couple of chapters. They are not, it's hard to quantify. It's hard to quantify how an irrational person is going to react to news. And so because it's hard to quantify it, accepted academic finance hasn't been able to build it into the models. And that becomes part of the problem with EMH, is that instead it ignored the noise traders. So noise traders include speculators and other market participants. They behave the same by buying high and selling low, and doing crazy things like that. So the noise trader agenda, there are many, sometimes silly reasons that investors buy and sell. You know, we've talked about it before, where maybe I'm selling my stocks because I want to put a new extension on the house. And so I'm selling there. It's not because of any news. I'm selling for completely different reasons than what EMH would count for. So there's all these different reasons that people have for what they're doing. Maybe I'm just happy with the profits I've gotten so far and I'm out based on that. So no one suggests that all traders and investors are rational. Experience often would obviously suggest that that's not the case. The existence, though, of noise traders is not enough to show that EMH is in trouble. For that, what we really need is noise traders' behaviour to be systematic, more like herd activity, and noise traders need to survive economically. Unfortunately, lots and lots of speculators don't survive, but there are still a large portion that do, and would suggest that the EMH does have trouble in that area. So that's the noise trader and the law of one chapter. So understand the concept of fungibility and the interchangeability of assets, costless interchangeability of that, and then identify what defines a noise trader, as we just did. So we'll continue on. Noise traders as technical traders. So this one is probably more about us, sorry. And so let's go on. Obviously, we have strange terminology. You know, when other people look at it, you will talk about things like the market's forming a base, you know, the stock is oversold, market broke through resistance, stock is exhausted, gold fell through support. You know, there's all these things that we talk about, and they're the domain of us, the technical traders. And so it's very interesting. It's actually a very interesting chapter to read, this one, because you're hearing a non-technical person describe the CMT program and the MTA, and yeah, it's very interesting how they talk about it. And at least, you know, it's not disparaging overly so. So technical traders are a form of noise trader. Is what this comes down to. According to the EMH, we are not considered to be rational traders because information can come out, we don't care. We're still looking at our price charts. We're looking at overbought and oversold indicators. We're looking at trend. The fact that information come out doesn't really make that much difference to us. Within reason, you know, if it starts reflecting in the price chart, then yes, we're all over that. We do behave in a herd mentality. You know, if we start all seeing the trend change, we're all jumping on that security as well. Information is not the primary concern, not using information that is considered true and relevant, as I said. Charting is widely used and patterns are widely agreed upon. This means that they, being us, are a large part of the trading community and they are systematic. Technical traders that act as a herd, such as trend followers, are likely to be able to cause over-optimism or over-pessimism and thus distort markets. Led to many other models like Shiller's. So Robert Shiller did a lot of work in this behavioural finance area. Another great book, that's worth reading is his one there. He argues that EMH implies that the price of a stock is simply an optimal forecast of the future stream of dividends. It's like what we said, if I know what the future stream of dividends are going to be, I will buy that stock for that stream of dividends. I'm not necessarily buying it because I think the price is going to be going up or down. EMH would basically imply that that's the reason that we buy stocks. But the data doesn't support that. That's not what research shows, and Shiller in his own research showed that that's not the case. His model concludes that EMH is not sufficient in describing stock price movements. Irrational investors must be included if a better model is to be constructed. Exactly what we're saying, the irrational noise trader has not been included in the models. Other models consider the effects of bubbles and crashes, but they're still not well understood. So, there's still more work and research that needs to be done in this area. All right, so that is that chapter. Nice and quick, these ones. Technical traders being noise traders, explain why technical traders are considered a noise trader. And that really is because we just ignore the information. We ignore that core tenet of EMH, that we should react only to information. Explain the implications of technical traders in the market. Over-optimism, over-pessimism is definitely part of that as well. All right, last section that we have here, academic approaches to technical analysis. So Andrew Lowe wrote this chapter, again, fantastic. And the work that Andrew Lowe has done for technical analysis is absolutely incredible. If you ever get the chance to hear him speak, fantastic presenter as well. So definitely worth reading the chapter. I think this is chapter 29. And, as I said, anytime you can hear Andrew Lowe, definitely worth speaking to. So he looked at all of this as well, and we're just going to run through these points pretty quickly. Efficient market hypothesis, human behaviour is the central limitation. Rational, this is really contrasting the difference between EMH and adaptive market, which is what Andrew Lowe has proposed. Rational participants with rational expectations acting instantaneously, but sometimes only trade for liquidity. So EMH thinks that we're all rational and we're going to act instantly. But as we said before, there's different reasons why people would trade. And we don't always have the resources to act on the information that comes out. Prices reflect all relevant information. Market aggregates information efficiently, but noise in the market. That's more the Fisher-Black model there. EMH is at odds with behavioural finance. Too many biases have been identified, which pokes holes in the rational investor argument. EMH is based on random walk, as we talked about. Doesn't account for low frequency information. And that's, again, a simple moving average strategy can be better than buy and hold. So then the adaptive market hypothesis is based on biology and adaptation, looking at different market phases, and that, again, these market regimes. Observes that markets aren't always efficient or rational, they are adaptive and Darwinian. Framework where EMH and behavioural biases can coexist. And then we go into the sections on, what Andrew Lowe talks about and why technical analysis is still relevant. Asymmetric information, market participants respond to different rates. We may get a piece of news come out and you're going to have some people that act instantly, other people want to process it and think about it, and then they react. Noise in the markets can create inefficiencies. Again, that Fisher-Black, informed versus uninformed traders. Sometimes people are only trading for liquidity reasons, as we've said. Several academic papers have shown that technical signals cannot be explained away, and they do produce some sort of predictive power. Studies have also shown that heuristics used by technicians, the rules of thumb and the belief systems, that matches highly complex genetic algorithms or machine learning neural networks and that type of thing. Our ability as technical analysts and traders to get to know a market and get to know our indicators and to know when it's starting to turn, that it has a predictive quality to it. It takes it. We still haven't got machine learning and computers to that point. Rather than trying to become computationally perfect at prediction, I think the industry went more down the path of let's go for speed and high frequency and just scalping off fractions of a penny instead. Scientific method says the simplest explanation is likely the best. So technical analysis is still relevant. A few papers there as well. Andrew Lowe himself there strongly rejects EMH with simple volatility based specification tests. Another few tests there. All of this sort of talking about why technical analysis is still relevant. I think chapter 29 is one that you definitely want to read. Just have a read of that between now and the exam. It's not long, it's only about 8 or 9 pages, so it won't take you very long at all. Okay, so that's the academic approaches to technical analysis. You need to be able to contrast the EMH versus the AMH and be able to sort of understand the differences there. Describe how technical analysis remains relevant despite EMH. Again, there's not a lot of questions that we've seen in the past on this stuff, but just having that understanding and then trying to think logically. If you get a question coming up in the exam, think about it in terms of, efficient markets believes that all information is reflected in the price, and try and discern. I'm sure that given a question, you should be able to eliminate 2, hopefully 3 wrong answers and leave yourself with the right answer as well. And then that's the efficient market. So, there's an interesting few points, I think, which are worth saying about EMH. And that is that what's not talked about either in the defense of EMH or the criticism of EMH is really the framework. If I'm looking at purely large mutual funds that are reacting to news and analysis and value investing, then the EMH actually may be completely valid. And I think to sit here and say EMH is completely invalid, it's false, is almost just as naive as saying EMH is the only way. There's always with these things an element of truth, and it's having that balanced approach. So in a fundamental world, it may be balanced. It may be valid to have EMH. While it attacks TA, in the end, obviously technical analysis also debunks EMH as well. And again, that's then looking at different time frames. What's our horizon? What's the investment horizon? How are we getting those gains? And it comes back to the example I think I gave in a previous session, where I was talking to somebody who was doing technical analysis on a yearly basis, looking for gains over a year, but he worked in a fundamental shop, and all he was allowed to do was time the entries and exits when the fundamental analysts had said, right, we want to add this to our portfolio or we want to take it out. And so his job was a short-term job. And it's the same here. We don't know the time frame that these studies were done under, the investment horizons. And so that's where this becomes a little bit difficult as well. And I think we've got to be careful of these wide sweeping statements. EMH was formalised first. We talked about that. So that made it stick in academia. And hopefully all of us together can help dethrone EMH as the one and only standard and be able to offer some really good alternative views there. And obviously it was a time where there was a little empirical testing. When EMH was established, there wasn't much technical analysis testing. We didn't have the quantitative tools that we have now. So hopefully we're going to see that changed a lot. So there you go with efficient markets. There's a lot there. We covered a lot of things. Honestly, all of this is going to probably only be a few percentage points of your exam, but they should be easy marks to get. That strong, semi-strong and weak forms, know them, and that'll put you instead. Do the practice exams, do the quiz at the end of this section, and that should put you in a great position for the exam. All right, so I think that covers most of the material now. We've got ethics to go, and then our exam review. Ethics, we've got a contribution from Mike Carr, which I think is already up on the website there, so you can look at that as well. And then in the final week, I'll come back with a bit more of exam review, how to prepare for the exam as you're coming closer to it, and just round everything off. So thanks for watching, and remember, go to forum.optuma.com if you have any questions about the material, something doesn't make sense, please go there and ask, because we're there to help you in any way we can. Thank you very much.